Hey Wizard, I got a really cool one for you today. We are going to live calculate an arbitrage opportunity using options in crypto. So this is very exciting. Let's get into it because the markets are moving fast. So I got to move quick and then I'm going to slow down and explain everything that's going on. So the first thing I want you to see is that I have an options chain up here with Delta Exchange and I'm interested in this strike price, the 21,500. Now I'm going to plug some numbers in and then slow down and explain what's going on. So right now, we are looking at a bid price on the call side of 141 or 143, whatever, right? So let's go and put in 143. And then on the Deribit side, I'm looking at a price on the put side at 21,500 of 171. So they're 171, great. And the futures price is 21,450. So 21,450. And the strike price we said was 21,500. Phew, now I can slow down. Let me explain what's going on here first of all. The first thing I did was I opened up two options chains across two different exchanges. I couldn't help but notice that the options prices between these two different exchanges were vastly different. And even though the bid and ask spreads, in my honest opinion, in options in crypto are disappointingly huge, and it is disappointing, and I wish they weren't so big, but they are. Even though they're so big, using the correct bid and ask prices, I've still been able to calculate arbitrage opportunities, and ones as well that are about $10 larger than the one that I just showed you. In fact, I know how to get them automatically now, and I'm going to show that to you as well. But first of all, let's go through some theory. If you're well versed in options and you understand options really well, you can skip about 5 minutes. If not, let's take 5 minutes together to explain this. So what did we do? We went through Excel here. I entered in the bid price of a call option and I entered in the ask price of a put option on two different exchanges. On this side of the calculation, I'm using the actual futures price, so the current price it was for Bitcoin, and the strike price here for the options chain, which related to both the put and the call, but in the calculation, I'm putting it on this side. And that gave me a positive number. You see, there's something called put-call-parity. And I've done a video ages ago on put-call-parity, but it's a real thing because what it says is this side of the equation should be equal. So I'm just gonna here put two equal signs so you can see that that's supposed to be a thing. This side should be equal to this side, but it's not. And the problem is if it's not equal to that side or the advantages, then you have a potential arbitrage, and it is an arbitrage if it's higher. So there's also some fees, etc. we have to take into account, and I'm going to show you all of that. But let's first go and look at how I know that there's an arbitrage opportunity here. What is the logic going on? You might not understand options. I'm not going to go into depth in options in this video. I've done lots of video on options or videos on options and options in crypto, but I'm going to give you the key takeaways, just what you need to know to follow along in the video. So if we go over to Excalidraw here, I've just drawn up a quick diagram to explain to you what's going on. But let's say here we're selling a call option because that is what we're doing. That's the first thing we did. We said we're going to sell a call option because it's the bid price. Remember, you sell at the bid and you buy at the ask always. So you're always getting the worst price. We are selling at the bid price, and that means we are getting our option for, or we're selling it at $143. Now, the way an option works is today I'm on the 9th of March. These contracts expire on the 10th of March, right? 10th of March 2023, 10th of March 2023. So these contracts expire on the 10th of March. But right now, the price as of today on the 9th of March, and I need to just update this, was 21,450. Blimey, it moved like nearly $500 since I last prepared this. Wow, Bitcoin's moving fast today. So there we go. So 21,450 is the current price. Now, essentially what needs to happen in order for me to keep my profit that I sold that call option for, because I instantly get that cash. When you're selling an option, you instantly get the cash. And I sold my call option, excuse me, it was for $143. So essentially what I'm doing here is I'm taking in plus $143 of income. Now, here's the problem. If the call option, or let me say it this way, if Bitcoin's price in this case was to go up, if you are the net seller of a call option, you can lose an unlimited amount of money. Very dangerous. I never recommend to do it to anyone. I don't recommend you to take on any kind of risk like that. But nonetheless, right, if you are the net seller of a call option, then if the price of Bitcoin goes up, you lose money. And if the price goes down, you get to keep your fixed income. And the price has to go up, more than a certain amount, basically, in order for the other side of the contract, the other person, to make a profit. If I'm losing money, they're making money. However, something else we can do is if we go and sell that at the same time as we can go long on Bitcoin. So this is very interesting because I'm getting this premium in here. So I sell the call option. But if the price of Bitcoin goes up, I might be losing on the call option, but I'm actually now making money on purchasing the actual underlying, which in this case is Bitcoin. And therefore, this loss is negated by this profit over here. Now, the downside of that is if the price of Bitcoin goes down, you can see I lose money. And that's only partially covered by the call that I sold. Covered call. Using a lot of terms that options traders will be like, okay, I see how we got there. But here we go. So there I've taken the income there. And here I'm losing some money there. But then there is a third side of the trade, and that is buying a put option. See, the put option is basically the opposite of a call option. And if I'm buying a put option, what that means is I make money if the price of Bitcoin goes down. I make a profit. And if the price of Bitcoin goes up, I just lose what I paid for my put option, which in this case, let's go and copy the text I had up here and let's put it down here. What did we pay for the put option? Let's go and have a look at that. That was $171. I took the price there. So 171. And granted, the prices were moving a lot, so it could have been lower, it could have been higher than that. All right, so that's what I paid there for that put option. And in fact, let's put that here in purple so that you can see it's for the put option. So I will lose that amount of money if the price of Bitcoin goes up, but I can make almost an unlimited amount of money if the price of Bitcoin goes down. So the arbitrage happens here. If you combine selling a put, buying and going long on the underlying, or going long on the futures price, for example, and buying a put, sell the call, go long on the underlying, buy the put, you end up with this, a guaranteed net income. Now, the prices have to be right. So the arbitrage has to be there. Otherwise, normally you'll end up with a guaranteed loss, which there's no point in doing that. We're not turning up to lose money. We're trying to turn up to make money. So the idea here is to make this net gap. And so that is what's going on over there. Let me actually illustrate it now with numbers to you so that you can see how that works. So scenario one, let's say that the price of Bitcoin between now and when the options expire, which is on the 10th of March, right, goes up $500. So I'm going to use 500. I make a net profit here of $22, which matches this 22, and it should match. The numbers should be the same. Otherwise, the maths is wrong. And we can see here that if the price goes up, our call contract loses money. So here's our call contract. Remember, if the price goes up, our call contract loses money. So the price here has gone up by 500 and we lost money. Interestingly, if the price only went up 100, we have a different, actually a different story. So let me add this here like such. So if the price only went up 100, then it would have been a different story because of the way options work and something called time decay, it actually has to go up quite a lot for me to lose money. But anyway, that said, we're going to stick with 500 because I want to keep things simple. That call contract would have lost money. The put contract would have also lost money. And that's because put options make money when prices go down. So I bought a put contract, it also would have lost some money. Okay, not great, but hey, this is an arbitrage transaction because we went long on the futures price. And if you're long on something and it goes up by $500, you make $500. So the sum of these three things here is our arbitrage, which is 22. But now, what if the price went down? Well, this is how to calculate that. if the price goes down by 500, so we just keep this amount the same as that, then the call contract actually expires in the money. I get to keep what I sold the option for, right? So if we go back here, the call contract, if the price goes down, I get to keep my profit. Excellent. So we've got that profit, we get to keep that. And then the put contract, what actually happens here, sorry, we're down at not scenario 1, this is scenario 2. So with scenario 2, with the put contract, is I make money, because what happens with a put contract, if you own the contract, if the price goes down, I make money. And it needs to go down substantially, because guess what? If I go back here again and I change this to say only 100, I actually would have lost a bit of money on that put contract, even though it went down here by 100. It has to go down by a fair amount for me to make money on it. And you'll also notice if I change this amount, it doesn't change my arbitrage. My arbitrage is still the same because it's a flat line. The arbitrage is a flat line. Doesn't matter what the price does. If you nail these exchanges to good prices, you've locked in your arbitrage. Excellent. So there we go. So here's the calculation, and I make money on my put contract. So I've made money on my call and I made money on my put, but I've lost money on going long on the futures price. But it just turns out that because of the, let's call it mispricing between the two exchanges, I go and make a net gain of $22. It doesn't matter how much the price goes up or down by in either scenario. Does not matter. I lock in profit, and that's the arbitrage. Now this is known as put-call parity. Let's carry on, because the other thing to bear in mind are the costs, and I'm not even sure I've quite got these costs right yet, but you can check it out with me. I'm taking here what I sold my call contract for, which is 143, multiplying it by the exchange fees multiplied by 2, because these are exchanges. They're not going to let you get away without paying the commission on the settlement as well of the call contract. So there or thereabouts, that's the cost of my call contract. I've got the same with my put contract. And then I've also applied this amount on the futures, and I'm sure a lot of you can get a better commission than 0.05% on going long on futures. But nonetheless, I've multiplied that by 2 on the underlying as well. And the costs I'm coming up with here are 21.76, meaning I only would have made 24 cents on this trade. Now, that's this trade. Some of them are a heck of a lot more promising, and I'm going to show them to you right now, because one of the things I could not resist spending time on was, and I've wanted to do this for ages, by the way, for ages, is what if you could have a script that could search through every price, every options price, bid, ask on every chain, on both exchanges, and compare them instantly. I'm going to say instantly within a couple of seconds. And, well, I've got good news for you. We've done exactly that. And here you can see this is how I found the last one. In fact, when I spotted the opportunity, it had a $33 profit minus the cost. You're looking at about $10, $10, $11 profit. Excellent. So what I'm going to do here is just clear my terminal, and I'm just going to go and run the script. And when I go and run the script, you'll see in a second or two, it goes and spits out the opportunities. And there we go. I mean, it's really, really quick. And here I can now see this opportunity at $22, which, by the way, hasn't moved, because look, it's still at $22. But the good news, sorry, I'm jumping around a lot. Let me slow down. The good news is that there's 8 opportunities. If I scroll up here, in fact, let me make this window bigger for you. Here's another one where, and in fact, that's actually quite a small opportunity. Let me look for a bigger one. $18, $29. Here's another good one. So $29, this is on a 23,000 strike price on a contract for the 28th of April. And $15, although that probably won't cover costs. Yeah, so really, there's only one good arbitrage opportunity here. Now, I've been running this constantly, and they keep popping up. And it's very clear to me that there are people that must be doing arbitrage with options, but they're not finding the same opportunities as I am when I'm finding them, meaning they have a different algorithm that's running on a different time frame. So one of the ways that you could compete with that is you could try to do this manually. I don't recommend it. I'm not doing it manually. I can't recommend you do anything because I can't tell you to trade or not to trade or teach you to trade. I can only show you what I'm interested in. And what I'm looking to do with this and what you could potentially do with this is use this as a search algorithm, right? So the idea here is if I actually show you the code, you've got your main function. This runs all the code. If you don't do coding, don't worry about it. I've still got the code package for you. So you can just follow those instructions, run this. You'll still see the opportunities. And also the Excel file I just showed you, this one here, is also included here. I'll make sure the very latest one is here for you as well. So in this code pack is also the Excel file. But the idea here is you get the prices, you structure the prices, and then with that optimal structure, you then have your search algorithm here. So if I go to this arbitrage tab, that's what this tab is doing, right? It's actually going and running a bunch of code and getting those arbitrage opportunities. Now, this is free for you if you are an Active Wizards member. And I'll just remind people that because I don't want you going and paying for this if you're already a member of Crypto Wizards. All you do when you sign up is make sure you use the same email address as you use at Crypto Wizards, right? And this should all be free for you. This very video here, I'm going to put here in the description. And there's also a video walking you through here, me actually getting the code, getting it running. It's very quick and easy to do, but I'll talk in a bit more detail around how to actually work with and use that code. And so you can watch that. And then there's also just written instructions. It's actually very easy. Even if you're not a coder and you followed the instructions that you get here when you're logged in and down here when you install the program, even if you're a non-coder, you can go and run this. Now, Wizard, I got to tell you, I thought that was a lot of fun. I love options. I'm interested in options. I think options are the way to go. You've seen me cover all sorts of funky options videos here on the channel as well. Most importantly, Crypto Wizards as a YouTube channel has been going for more than 5 years now. And I thought this was a great way to celebrate also hitting 15,000 subscribers on this channel. This channel doesn't get promoted. I'm not here to grow as a YouTuber, and yet we have been here for 5 years together. We're still here, we're still working together. So well done. I'm glad to be a wizard. I hope you're glad to be a wizard, and I shall see you in the next video.